Hello and welcome to our recap of our lecture on an introduction to groups. So we're going to cover here the core areas that you need to know in order to produce group accounts. We're going to talk about definitions of control in particular. We're going to talk about when to consolidate and then some rules that we need in order to consolidate our group accounts. So starting off with those definitions that we talked about. We talked about control first of all and the actual definition per IFRS 10. That was that an investor is exposed or has rights to variable returns from the investee. So how do you get that? Well, that basically says you bought some shares and you're going to get some dividends from them. So it's exposed to getting those dividends, variable returns from the investee. And, however, has the ability to affect those returns through power over the investee. So that means that you need to have the ability to change those returns through the decisions that you make. Therefore, you control that subsidiary. Now, that's the actual definition per IFRS 10. We'll talk about exactly what that means for the exam shortly. We also talked about a group, and a group is a parent and all subsidiaries. We mentioned a non-controlling interest. Remember, the non-controlling interest is the equity in a subsidiary that is not owned by the parent. So if you buy 80% of a subsidiary, well then the 20% is the non-controlling interest, the bit you don't own. Lastly, a subsidiary, well the key thing you must remember and you must know is that a subsidiary is controlled by the parent. So remember that definition of control. However, let's look at the actual nuts and bolts of when you would consolidate. And remember, it is all about that control that we talked about. We know the definition, but what does that mean in practical terms for the exam? Well, it means that you will have control if you have 50% plus of the share capital. Because thinking about the definition, that will give you the ability to affect the variable returns from the subsidiary, because you'll be able to implement decisions that will affect profit, that will affect the dividend. So that gives you control of the subsidiary. That's the one you'll usually see in the exam. Don't forget though, if you have a majority on the board, that means you control the subsidiary. Or indeed you have the right to appoint or remove a board majority. That will give you control of a subsidiary. So look for those in the exam. Those are the ones that will determine if you have control. We also talked a little about convertible debt. Remember, you could convert this into shares, and maybe if you did, you would have over 50%. Does that give you control? Well, you need to look at the management intention and their ability to convert. If they intended to convert them and they were able to convert them now, well then yes, that could potentially give you control. If the subsidiary is in a different industry, do we still need to consolidate? Well, yes, we do. There's no exemption for a different industry. If we control it, we consolidate it in the group accounts. Times when there's no need to consolidate would be if the parent was a wholly owned subsidiary themselves, or if it's not a listed company. So those are the key bits for the exam. Learn them. Now some rules. Now we'll come across these as we do our group workings. But in practical terms, all group accounts is a combination of the financial statements. We add them together. We add together the parent and the subsidiary line by line. We add together their assets. We add together their liabilities, their income and their expenses. Now we'll look at some technicalities on those, but that in essence is what you do with group accounts. We present those as a single entity. We take away the investment in the subsidiary in the parent's accounts. We'll see how to do that. And we use the parent's equity or share capital only. We don't add the share capital together. When it comes to the non-controlling interest, remember they will get a share of the profit or loss for the year. and they'll get a share of all the assets and liabilities on the statement of financial position. So you'll have the NCI at acquisition plus their share of profit, and that will be shown in equity, and we'll see that as we do our group workings. We also have to eliminate intra-group trading, so we take away the intergroup balances, the intergroup transactions. For example, the profit earned between a parent and a subsidiary is taken out. Also, we remove dividends and deferred tax. So all of those we'll deal with as we go through. Some technicalities. Should they have the same reporting date? Well, yes, they should, unless it's impracticable. So you should have the same reporting date for the parent and the subsidiary. And the difference, if it can't be the same, should be no more than 3 months. They should have uniform accounting policies. However, that's not necessarily the case. The parent and the sub may have separate policies, in which case adjustments will need to be made to the sub to bring it into the group accounts. So the process we're going to look at in our future lectures, remember, is to identify the parent and the subsidiary, identify the subsidiary's assets and liabilities that have been purchased, measure goodwill that we'll meet in the next lecture, measure the NCI, the non-controlling interest we talked about here, and then disclose all of the detail around the group accounts. So that's our introduction to groups. That's the things that we're going to see as we run through our group accounting. Make sure you learn the definition of control and what that practically means when it comes to group accounts.